Marty Whitman was the manager of the Third Avenue Value Fund, ticker TAVFX, until March 2012. During his time at Third Avenue, his approach could be referred to as vulture investing, given he would routinely rummage through the capital structures of distressed companies, some in or on the brink of bankruptcy. Whitman's strategy was to buy companies, in other words their equity or debt, that were cheap, presumably because of some temporary issue, and safe given some type of collateral in place to prevent impairment of the principal he invested. And then he would hold on to them until the asset appreciated in value due to a reorganization, turnaround, or monetization of assets and return of capital to creditors or shareholders. Whitman's approach was very similar to the approach employed and concepts taught by Ben Graham. Like Graham, Whitman looked for stocks that were dirt cheap. However, the two investors used different measuring sticks to assess cheapness. Graham frequently used a company's price-to-book ratio to determine whether its stock was cheap. He would generally buy only when a company's stock was trading below a book value of 1.2 times per share. Whitman, however, focused on a company's takeover value, or how much he thought a buyer would pay to buy the whole company. Similar to Gabelli's private market value, except Whitman's wheelhouse usually included companies that couldn't be valued using multiples of their current cash flow given their distressed state. He would look at reproduction values of a business to account for both tangible and intangible asset values, or apply multiples of cash flow that he's projecting post-reorganization or restructuring based on whatever he interpreted the likely business plan and resulting profitability of the distressed entity to be. Whitman didn't like to use book value because he said it overlooked too many intangibles. His view of the takeover value was that it often accounted for such intangibles, which is the approach we refer to as reproduction value of a business. This valuation methodology is analyzed in much greater detail in Chapter 8 of this course.